There's this myth in Silicon Valley and the startup world in general that the best founders are grinders. I don't think that's a helpful way of thinking about it.
Very happy to host my guest, David Peterson, on the podcast today. He was the former head of growth at Airtable and now a partner at Angular Ventures, where they're investing in deep tech and B2B across Europe and Israel.
Things that work tend to work very quickly. And I don't actually fully agree with that. I think that there are lots of examples of things that didn't work fast, but ended up being. Airtable took 4 years to get to product market fit. And it's an amazing product and a big company. That did not work quickly.
Is being a VC as exciting as being a founder?
The jobs are so different. It feels very different. Every single day feels very different. When you're a founder, the highs are higher, the lows are lower, and they're closer together. In a single day, you can have the best morning of your life and the worst afternoon. So your stakeholders are just different and the time scales are different. It's just the day-to-day feeling of the job is so different. Really, I think this idea towards thinking of your startup as a experiment that you're running, it requires a real shift in mindset. And when I'm talking to a founder that I just invested in, right? I really want to be talking about experiment design. That's what I'm thinking about. Thinking about what is the hypothesis we have and how can we get a definitive yes or no as quickly and as cheaply as possible? That's the whole game.
Does that understanding comes from your background in growth? Hey, David, welcome to the show. How are you doing today?
Doing great. Thanks so much for having me.
It's a pleasure to have you. All right, so I'm going to start us off with a question that I ask almost everybody that I had a pleasure of hosting on the show is, what's the earliest context you have of your life and how did you end up becoming a VC of all things?
The earliest context, the earliest memory?
Yeah.
The earliest memory? Oh my God. I don't know if I have a good answer to that. That's an interesting question. Look, I feel like a lot of my earliest memories are childhood, running around my backyard, that sort of, I feel like this very carefree, classic millennial suburban childhood, right? Where you come home from school and you go outside and you're just running around until it's dinner time, and then you eat dinner and then you go run around until it's dark. When I think about my childhood, that's what I think about. And in terms of it being a VC, geez, that has absolutely nothing to do with my initial memories of my life. My road to being a VC really goes through being a startup founder and working at startups, right? That's what I've been doing for the past 15 years. And I had a little bit of exposure to venture. I worked at a firm in the States called Founder Collective while I was in business school at MIT. So I kind of saw what it was like, but I very quickly was don't want to do that. Let me get back into, working at startups. It really was, I worked at startups for a long, long, long time. And then I was trying to figure out what I was going to do next, wanted to go back and work in early stage, building something again. And I kind of got convinced that maybe the best way for me to work on something early was actually to be a super early stage VC that leads really early rounds in pre-product, pre-revenue, companies. And the beauty of that is that I get to work on early stuff every single day. It's like Groundhog Day. I'm always working on something early. I think that's how I kind of ended up in VC. I certainly never expected it.
All right, awesome. Is being a VC as excited as being a founder?
The jobs are they're so different. It feels very different. Every single day feels very different. When you're a founder, the highs are higher, the lows are lower, and they're closer together, right? In a single day, you can have the best morning of your life and the worst afternoon, and that happens all the time. It's very quick, right? It always felt there's an urgency to your life as a founder. Venture just isn't like that. Everything is protracted, which isn't to say there aren't urgent problems that sometimes you need to deal with, right? But the time scale is so much longer. The fund is a 10-year fund. It takes 7 to 10 to 15 years for an early stage bet to turn into anything. Your relationship with an LP, the people who are investing in us, when they are investing in us, they're usually underwriting to invest in 3 funds. That's how they think about it, right? That's even more protracted, right? So your stakeholders are just different and the time scales are different. It's just the day-to-day feeling of the job is so different. But I find it very intellectually interesting too, right? Like as a founder, you're so laser focused on the one thing right in front of your face. Like that is all you care about is solving this problem. But as an investor, you have a portfolio of problems that that you're thinking about, and that's very intellectually interesting. I've found.
Yeah, it always fascinates me. I've hosted a lot of VCs on the podcast. Every single time I ask this question, every single time I get a weird sort of an answer. Like not a different, but a weird sort of an answer. Suppose you invest in like 50 companies over the period of time. The fund is like 10 years, it has a lifetime or like, so you've already shared that. Suppose you've invested in 50 companies, right? And all of them are exactly the same early stages. There's 50 problems. So how do you help founders in navigating through those problems?
I think the real answer to, or like the unfortunate answer to that is that there are only certain types of problems that VCs can actually help with. In my mind, a big part of being a VC is figuring out which problems you can help with and which problems, another way of putting it is that, something I thought a lot about when I was at Airtable is I remember having some very long conversations with the CEO, Howie, about this, is that there was a certain point, look, for a long time, his job at the company, he was basically he was the product person, he was the fundraiser, he was everything, right? Like he was doing it all. There was a certain point in the company, and it was much earlier, I think, than any of us would have thought. There was a certain point in the company where his job was really to be a capital allocator, right? His job was like, how do I become excellent at investing? And that's investing his time, right? But it's also about like, who should I hire next? Because that's going to cost money and money is limited. So I need to make a good investment in the marginal person that I hire. What product do I focus on? It could be actual investments too, like this growth marketing channel versus that growth marketing channel, whatever. So anyway, we talked about that a lot. Like that is the real job of a CEO is as a capital allocator. And that's a conversation I try to have with founders that I work with too. Is that like, I'm not going to be able to help you decide whether but most of the time, right? I can try to help you see around corners and all that stuff that VCs always say, which I think is all right. That's what you should do. But ultimately, it's about like, helping founders have this mindset towards being capital allocators rather than most founders are thinking of themselves as being like, I'm a salesperson, right? Or I'm a product person, and that is what I am doing. I'm building product all day long. I'm shipping. That's all I'm doing. It's like actually abstract yourself out one layer and think of yourself as a capital allocator. You know, so that's like probably a weird and not great answer to the question too, just like everybody else gives. But I think like if I do my job well, that's what I'm having that type of conversation with people. And then we can have whenever they have a problem, the problem that we're talking about is probably a capital allocation problem. So it's always within this same context, right? Right. And then I might be able to actually help. Whereas, if you come to the table and say, oh, I have this HR problem and whatever, like there's so many specific problems that happen at companies that investors, I guarantee you, cannot help with. They're just useless. Even if they say they can help, they can't help.
Totally agree to that. There's a whole bunch of things that I want to ask you about your time in Airtable, but now that you mentioned one thing, so I just want to touch that a little bit. When a founder raises money, it could be any round. So specifically pre-seed, seed, and Series A, so the three stages. As an investor, what do you expect them to do with that money? Because, and I'll give you somewhat of context with that question. Most of the times, and I happen to meet founders almost every day, a couple of times at least. Um, there's a very funny one that I'm going to share with you. So there's a guy who just raised 2.5 million. That was a year ago or something, 2 years ago in 2022, and then they just hired a bunch of C-level executives, as a CPO, a CTO, a CMO, or something like that. A year later, they just ran out of money like that because CMO wants to have $500,000 ad spend budget or something like that, so they just ran out of money. Yeah, and now they're like in the same problem again. It's 2023 now. They need to fundraise again. Nobody's paying them. So all kind of problems. So as an investor, what do you actually want to see from founders? Like, okay, so you raised the round, you're taking the money. What do you want them to see doing with that money?
So I think this comes back to like, what is a startup? A startup is a small group of people that are dedicated to testing a novel hypothesis for creating outsized value, right? If we agree about that, then the best founders, in my estimation, are excellent experiment designers because essentially what you're doing is you're raising money to run an experiment and the experiment is to test the experiment that you're running is testing that hypothesis. We think that we can create outsized value. Can we? Yes or no? Right? Um, I think that sounds obvious, when I phrase it that way, but you'd be surprised how often, there's this myth in Silicon Valley in the startup world in general that the best founders are grinders, right? The best founders are those that persevere, right, through all the shit, right? And you get to the other side and you succeed because I just don't think I don't think that's a helpful way of thinking about it, right? I think because the reality is, like Elon Gill says this thing that like things that work tend to work very quickly, right? And I don't actually fully agree with that, right? Like I think that there are lots of examples of things that didn't work fast but ended up being huge, right? Airtable is one of them, right? Like Airtable took 4 years to get to product market fit, and it's an amazing product and a big company, right? That did not work quickly, right? That's 4 years. So I don't fully agree with it. But his point, I think like the real point he's trying to make is that founders shouldn't valorize the grind, right? Like don't think that just because you're grinding, like that is in and of itself good. And so, really, I think like this idea towards thinking of your startup as a experiment that you're running, that it creates a real, or it requires a real shift in mindset. So, and when I'm talking to a founder that I just invested in, right, like I really want to be talking about experiment design. I'm thinking like that's what I'm thinking about. I'm thinking about like what is the hypothesis we have, and how can we get a definitive yes or no as quickly and as cheaply as possible. That's the whole game, you know.
Does that understanding comes from your background in growth? Because primarily when you're in marketing, that's what you're doing. So you're just designing these little experiments. Okay, try that channel, that ad copy, that's something else, and then you figure out like which one works the best.
Maybe that's why, yeah. I mean, I've always kind of thought about it this way, and maybe that's why this was the intuitive way for me to think about it, because ultimately my background has been so much, based in experimentation.
Yeah. Okay. So let's just take us back to your early days in Airtable. So one of the things that I was reading, you were the first growth hire in that company. So there's a whole bunch of things that we can talk about. But the first thing is, what was exactly look like inside Airtable when you joined? Actually, was it still like chaos and like you didn't figure out like what the heck? Oh my god, like this is I don't know if it's gonna work. Is it not gonna work? Like how things feels like? Yeah.
Yeah, I mean, well, look, it was certainly chaos, but every startup is chaos. That's not unique. Yeah. Yeah, so when I joined, right, the product was still in beta. And we probably had a few thousand users, and we were thinking about starting to monetize. Like that's basically the moment we were at. Now, the product itself it wasn't really feature complete. Candidly, we were like under pressure from investors to start making money. That's kind of where we were at, you know. So if we could have done whatever we wanted, we probably would have built for a while longer before charging. But it was like, hey, we need to prove that we can actually make money here. So let's think about monetization. So then my job was, as a first growth person, was really thinking about one, how do we start pricing and monetizing right at a high level, but also more specifically, how do we as a horizontal product, how do we build a go-to-market strategy? Like, what does that look like? Because up until that point, we had kind of run like some random experiments, but really we hadn't really focused that much on go-to-market at all. Like if you looked at all of our, those few thousand users, most of them were like friends, right? Or like friends of friends or introductions from friends or whatever, right? So now we were thinking about how do we actually go to market? The reason this was challenging is because Airtable, was a horizontal product. So it really required trying to figure out what are the use cases and then how do we build novel go-to-market strategies for each of these use cases. And then how do we build a team that can execute on many go-to-market strategies in parallel and, and drive growth efficiently.
Okay. So for the audience, can you just clarify, like, what do you mean by horizontal products and vertical products? And the second question on top of that is, I want to have your expert take on how a startup can build a go-to-market strategy, like from point 1 to point 10 by the time it's like working, it's monetization. That includes all the things like how do you structure the pricing? How do you, add that tiered sort of pricing structure, like, okay, different tiers and all that. So can you please just lay that path for us?
So by horizontal product, I mean, it has Airtable is not a piece of vertical software that is built to solve a specific use case for a specific industry, right? Um, Airtable is a database that looks like a spreadsheet. You can use it for almost anything, right? Like a lot of different things across every industry you can imagine and across every function within that industry. There's probably a use case for Airtable. Um, so in that way, so that's very complicated. How do you focus? Like, where do you focus? Uh, that was the real challenge we had early on. Now, in terms of your second question about building a go-to-market strategy, so I think that probably the best reading that I can recommend on this is, Brian Balfour, who's a VP of growth at HubSpot and now runs Reforge. He has a set of blog posts, yeah, that are they're basically about like the four types of fit, and it's like product market fit, market channel fit, product channel fit, and there's one other permutation of that, something fit. And I think those are like required reading if you're thinking about building a go-to-market strategy. And the TLDR that I would take from those is basically that the the right channel for like the right go-to-market channel is going to depend on the product and going to depend on the market that you're going after. And similarly, like the right product is like it's obvious that the right product is going to depend on the market and vice versa. We always talk about product market fit, but that's also true for the channel. That's also true for how you go to market. And that's something that I think very often distribution is like a it's an afterthought with startups, right? You think about because you're so obsessed with building a product for a specific market and that they like it, right? You're so obsessed with product market fit that you don't think about like what is your distribution edge going to be. And it's one of my many kind of hobby horses is that, right, like you should be talking about what your distribution edge is going to be from the very beginning. Like it needs to be part of because the best distribution edges are part of the product themselves. And that's another way of saying that like, it's kind of taking Balfour's argument to its like logical conclusion, which is just like product market fit is kind of inherent to the product and the market that you choose, right? Like product channel fit, right, is also inherent to the product. So you should be building with that channel in mind, from the very beginning. Um, and so I always encourage like the startups that I talk to, and the founders I talk to, I'm encouraging us to talk about distribution like uncomfortably early, you know, um, because it should affect the way you build the product, right?
I wholeheartedly agree to that. This is one of the key lessons that I learned years ago. Like, forget about the product that you have in mind, figure out the distribution. If you have the distribution figured out, the product itself is going to figure it out itself. So there's a post that you put out on LinkedIn, and kind enough of you to just write a blog post on that. So just going to, plug that one in here. So there's this tweet, I forgot, by Justin, I think. And in the tweet.
Oh, Justin Kahn, right. Yeah.
Yeah. And he said something like, first time founders obsessed about building products, second time founders obsessed about building, figuring out the distribution. But the key takeaway for me was, in that footnote of that post was the founders should also innovate distribution. Like you talk about PayPal, you talked about Notion, and you talked about Canva. But one of the things that the key takeaway was founders should also innovate distribution. A couple of questions on top of that. So one is, can you please explain that distribution arbitrage blog post? And two is, what kind of distribution innovation you're looking for?
The argument I made in that post was I was kind of like, what, the question I posed to myself is, this is like this tweet from 2018 or 20, however long ago, it was even longer ago than that, I think, um, has kind of reached the level of like, it's like default startup wisdom, right? It's like people say it without even knowing that Justin Kahn tweeted it, right? It's just like a thing that people say. And I was like, okay, why has it become so well worn so quickly? Like, why does it resonate with people so well? I was asking myself that question. And, the answer that I came up with is I think it's because, founders recognize who have like played the game, right? They recognize that like any advantage that you can build in distribution is competed away very, very quickly. So you kind of need, and once it's competed away, then you're just kind of like playing the game that everybody else is playing, and it's expensive and it's hard, and you have no edge, whatever. Um, and because that edge gets competed away so quickly, if your plan is just to like look at the market and be like, I'll just do what that company did, you're going to lose, right? Like you're already starting from behind. So, and this is what I kind of call it, like this idea of the law of like diminishing marginal distribution advantage, right? It's like over time, any distribution advantage you have will be competed away. So if you believe that, if founders believe that, then they should also believe that from the very beginning, you need to build in some sort of distribution arbitrage, right? That so you have just a little edge, right, from the beginning. And then I started thinking about like, okay, well, what are examples of companies that actually had some sort of distribution arbitrage, and what did it look like? And so some examples I came up with, as you mentioned, were, PayPal, and PayPal had this whole, like, if you remember PayPal from the early aughts, right? Like PayPal enabled you to email money, right? That was basically the innovation. Or that was like the underlying technological innovation, right? But the distribution innovation was, we're going to send you $10 for every user that you invite. And I was thinking about like, why was that so viral, right? And it just worked so well. And on the one hand, it's like, look, giving away money for free always works, like that's pretty easy, right? But on the flip side, at Airtable, we had a referral, right? Like every other SaaS company in the world, right? We had a referral thing where you could invite a user and you'd get credit. And I know from my time at Airtable that the referral program like did not matter at all. Like that just it was not an impactful thing. It didn't move the needle at all. And I think the reason is because at Airtable, like, you're swiping your corporate credit card to get an Airtable account. This is like SaaS that you use for work. Like you don't care that you have $20 in credit. It's like you can't even use this for anything, right? It's like it just doesn't make any sense, right? The what was interesting about what PayPal did is they were giving you $10, but they also were giving you like it was actual dollars in your PayPal account that you could then use to pay other people via email, right? Like it was a closed system. There was an immediacy to it. So like the distribution innovation was linked deeply with the product innovation itself. And that is, I think, the critical takeaway, right? And that's why that's fundamentally interesting. And that's why I think Uber's referral, which I mentioned in the post too, that's why I think Uber's referral was also really meaningful, right? Uber had their whole referral program where, you would invite somebody and get $5, I think it was. And um, I remember, as a total aside, I remember I had a friend in New York who, back when this was was a thing, they had against Uber's terms, they had like posted their referral code on Reddit and like a ton of other places, and they had earned like thousands of dollars in credit, such that they were taking the Uber copter to the Hamptons like every other weekend because they had so much money in credit. And the whole thing fell apart because one time, by the way, that is like such an example of like the venture, what the world was like when everybody was flush with venture dollars, right? It's like how ridiculous that Uber was giving away that much money, it's like completely insane. But the way that this dream situation all fell apart for him is he had like an incredibly dangerous, like what he felt was dangerous driver one time who was like, doing all this like crazy stuff, right? And he was like, I need to report this. Like this was not safe. Like this is not okay. So he, gave a bad rating to the driver, and by giving a bad rating, it like prompted a review by somebody internal at Uber who saw that he had like $10,000 in credits, and they took them all away. They were like, this, this is clearly against the terms. So anyway, okay, that was a total aside. Um, but I think that's why the Uber referral worked, as well, is because yeah, you get $5, but the $5, as my friend experienced, was like immediately useful for something that was core to the product, right? Like that. So like the giving away the dollars as a user acquisition tool also drove more usage of the product. So there was a natural there was a compounding effect, right, to giving away that money. That CAC like made sense. So anyway, I think that those are examples of this idea of tying product innovation to distribution innovation, and I think that's something like founders in general should be thinking about from the very beginning.
What do you think in terms of an edge that you guys have as being an ex founder or an ex growth person or an ex product person? How does that give you an edge working with any company compared to any traditional, say, investment banker?
Sure.
Yeah.
I mean, yeah, no, look, I think there's very like the trick in venture is that there's tons of different ways to do venture, right? You can be a successful venture capitalist with like there are lots of flavors, like some of the best venture capitalists in the world are not ex-founders, right? They're just analysts, equity analysts, bankers, whatever, right? Like Bill Gurley, from Benchmarks, ex equity analyst, Fred Wilson, Union Square, right? Venture is all he's ever done, and he's one of the best investors of all time. So, for me to come in here and say that founders are the best investors because of X is like clearly demonstrably false. And so I think that the key to answering your question is to figure out like as an investor, you need to ask yourself, what game am I playing? And how do I make sure that I'm like the best at playing my version of the game? You know, that's the question that I think about a lot. And ultimately, when I think about being, having worked early at a startup and having been a founder and everything else, when I think about like, how is that actually helpful in playing the venture game? Probably the way it's most helpful is empathy with founders, right? And hopefully I'm able to, win a deal that I otherwise wouldn't be able to, right? Earlier in my career without as many wins under my belt. That's probably if I'm being brutally honest, that's probably the only thing that it could possibly help with. I don't think it really helps with like giving good advice or being a good partner to a founder or anything like that. I mean, I think it might, but the point is that there's lots of different people who are amazing partners to founders. So it's hard for me to say that my background is the only background that works.
What exactly is this market looks like? So the answer that I get is it's very collaborative. There's like very little to no competition going on. So it's a very collaborative sort of an environment going on. So, and the question and the thing that prompted this question was when you mentioned this thing that you are chasing a founder, which congratulations on closing the deal, by the way. So, couple of questions on top of that. Like, do you actually believe it's a collaborative environment? If it's a collaborative environment, how often do you guys have to chase good founders, good deals?
Whether or not it's collaborative entirely depends on your business model as a VC, like your model. If you write small checks that can slip in alongside a lead investor, then you can be as collaborative as you want to be. But the minute that you're a lead check writer, it is like definitionally not collaborative, right? So yeah, whoever is saying it's collaborative is selling something. I'm not sure what they're selling, but it's not collaborative. Um, and in terms of chasing, I mean, look, the way I think about this is the minute that you think you don't need to chase the best founders is the minute you've lost, right? Like I always ask my question, why would the best founder in the world want to work with me? Why do I even think they know who I am, right? They have no idea who I am. I need to go find them and I need to convince them that I can be a great partner. That is my job, like, and I say that because one, because I don't work at Sequoia or Founders Fund or whatever, right? I'm like, work at my own firm, you know, um, but two, because there's a ton of VCs out there, right? Like there's so many. So even if I did work at Sequoia, I would be, or found, or again, any of the firms, right? Sequoia is just a placeholder for whoever. Even if I did work there, why does the next great founder, why should I believe that they know who I am, right? And I think, by the way, like the minute that you start thinking that is the minute that you lose your edge. So like the challenge with this job, I think, is for decades, for decades being paranoid that you're missing out on the next great deal. That you just need to constantly be terrified. That is how you do this job well, I think.
Is that a high pressure sort of a job as well?
Yeah, no, yeah, for sure. I mean, look, it's high pressure, but it's high pressure, like I said at the beginning, it's high pressure over these like very long time horizons, you know? So it is high pressure, but it's a very weird, diffuse pressure. Which is what makes the job very strange, you know? And because I think one result of th this idea is that, the venture firms or venture partners in particular, investors, can lose their edge and still be in a job for a very, very long time because firms have a long life and LPs make deep long-term relationships, right? Like they're often underwriting, as I said, for three funds. So, you know, you may have lost your edge as a investor or as a firm, and yet you're still kind of around for a while. So it is high pressure, right? Absolutely. But the pressure doesn't bite for a while.
Why a founder would go and take Sequoia's capital? Isn't that gives them this sort of a sense like your employee, I don't know, 5,001 in General Electric or something like that. Like, you're just like whatever in Sequoia because Sequoia is Sequoia. Like they're like all over the world. They have
Yeah, yeah,
done
yeah.
big, right?
Right. It's so
So
big and
it's
yeah,
so
yeah.
big, exactly. And you'll probably dealing with an associate, let alone a partner or like whoever. So why people would want to work with Sequoia? Is it just because of the brand name, brand value?
Sure. Like, I mean, this is a funny question to ask me because usually I'm telling people why not to work with Sequoia and they should be taking my money instead. But I will happily play along. I forget who said this, but I forget who said this, but somebody, it might have been Bryce from NDVC. But it was, there was a conversation about like, what is the value that a VC actually provides? And somebody, again, I don't remember exactly who, basically said that like the main thing that a VC does is that they increase the likelihood of the next round being raised, right? Like they lower the risk, right, of they lower the financing risk. And look, I think like the argument for taking a brand name firm's money is that there's undoubtedly a halo effect of that brand, right? It makes you and your firm, your startup, right? It makes you seem like you are further ahead than you are, that you've figured out more things than you are, right? Like you're going to get a lot of credit, right, based on that halo effect. And that could be make or break, right? That could be really meaningful. Now, I think what you said is absolutely true, which is I wouldn't just I think that, not every Sequoia dollar is made equal, so I think that money is way more meaningful at a specific stage and tied to a specific partner, right? Another way of thinking about this is, Mike Maples says your fund size is your strategy, right? Sure, yeah, right. And, so Sequoia has billions of dollars. And if they're writing a $1 million check from their ARC program, right, which is run by whoever, but it's not like that is not a meaningful investment from Sequoia into your business. And what that means is there's nobody put their neck out at Sequoia and, to saying, I believe in this business, I'm going to do whatever I can to try to make this work, right? They need more money, I'm there, right? Like nobody did that, right? The check is too small. There's no partner aligned with that check, right? Like, and so that's why every dollar is not equal, and what I always say to founders is like, you know, partnering with a big multi-stage fund like that can be truly a trajectory changing event for a company, right? It can be incredibly, incredibly meaningful, but it's dangerous if you take that money in the wrong way, right? If you take a too small of a check, if you take it from the wrong partner who doesn't get who you are, right? Or if you take it from not a partner, right? If it's like a principal who's just kind of like trying to prove themselves and then they're going to be gone in 2 years and now you're orphaned, right? Like there are lots of ways that can go wrong. And partly I'm just talking my own book here, obviously, because I work at a small fund where because our fund is small, we are we are like perfectly aligned with an early stage founder. Because if we invest in you, and we're only lead check writers, right? So if we invest in you, like you're a meaningful part of the portfolio, right? We are making a meaningful bet on you. And so if you invest, we're aligned at that point. Like that we're on the same team. And also we're a partner only fund, right? There's nobody else. We're it, and that means you're partnering with somebody who's not dealing with politics, who's not trying to, right, who's trying to horse trade in the IC to get their deal over the line, to get the next person's deal over the line or whatever. It's like, no, like we are autonomous decision makers and we believe meaningfully in your business. And I think that's what you want as an early stage founder, right? Like that's like the most aligned sort of partner you could get.
Yeah. You mentioned one thing, which is which I was coming to. Your fund size is your investment strategy. Your fund size is your investment thesis. All of that. So a couple of questions on top of that. This is I know you're gonna say this thing, so I'm gonna ask you a question directly about that. Like why you think investment strategy or investment thesis is overrated, and two is what do you mean by your fund size is your strategy, and primarily for like founders, because founders feel like, hey, every pre-seed seed fund is exactly the same, which they're not. Terrible mistake. But yeah, yeah. Can you just answer that from a founder's perspective, like when they're reaching out, how every fund is not the same.
Yeah, so there are two questions, and the answers are actually really different. So your fund size is your strategy thing is all about fund economics, right? Like it's actually about like the math, like fund math, right? And so the way to think, like the shorthand you should use as a founder is you should always know whenever you're talking to any fund, you should know how big is the fund, right? Like is it how big is that vehicle? And then what is the check that this fund is going to write? And how many checks do they write per year, right? Try to make sure you know that. Because what you want is you want partners where you are a meaningful part, for which you are a meaningful part of their business. So um, if, and this is why, by the way, that it's really hard for multi-stage funds. And the other thing I should say, sorry, to go back, is that the fund math is all about, ultimately it's about returning capital to our LPs, right? Like we have $100 million fund, we're going to make 20 investments, right? Each of those investments are right 1.5 to 2 million, $2.5 million or something like that. Then we have reserves. Ultimately, we need to return multiples on that 100 million. We like 3 to 5x, let's say, right? Is kind of the target. And so we're looking at every position in the fund and we're saying, can we return the fund with this one investment? And the answer, like how we think about it, is we should be able to return the fund with any of these investments. We need to believe, at least, that we could return the fund with one of these investments. That's how we think about it. And I think ultimately that's like a highly aligned, way, highly aligned approach, right? Because that means like each of these investments is super meaningful for us, right? Now think about it if you're a multi-stage fund, if you're Andreessen or, Sequoia or whatever, um, or any of the others, right? There's so many. And they have like a new seed program, right? And they're doing a bunch of seed checks, but they actually have, you know, $5 billion under management. Now they do a $1 million, right, investment in your company, and they get they own 5%, 8%, 10%. How big does your company need to be, right, for that to be meaningful for them with $5 billion under, in that fund, right? With a fund that's $5 billion. The reality is they're not putting enough capital to work for that to matter to them. That $1 million does not matter, right? Like that $1 million is marketing budget, right? They're just like, so what's actually going to happen when they do that investment is they aren't really going to pay close attention to you because they don't care. Like, how can you, like, think about it. They invested $1 million in you and then $50 million in another company. Who do you think they're going to like pick up the phone for when they call? Like, who do you think, right? Obviously, they're going to focus on where their capital is actually deployed because if they can, 20x that $50 million, that's pretty meaningful. If they 20x that $1 million, it doesn't matter, right? It like doesn't affect them at all. So, yeah, so I think that's really what like your fund size is, your strategy is talking about. It's talking about like the fund math, and do you have a reasonable case to believe that this partner you're talking to will pick up the phone? Do they care, right? Are they incentivized to care about you? So that's the Maples quote. And that's how I think about that. Now, in terms of the investment thesis thing, I think that's actually like an entirely separate topic. That's more about like I think very often funds use theses as a way to yeah, it's kind of like as a way to this is very cynical of me, but I think it's often a way of selling to LPs, showing that they're smart, right? To say like, look, we have this like we can see the future. We have this unique way of thinking about the world, so they're kind of selling to LPs. And it's a way of, yeah, to your point, like screening, filtering pitches. Like I only want to hear about this stuff. Now, my critique of that whole approach is that I think VCs do not know what the future holds. I just don't think any investor actually knows. If they did know, they would be doing something else. They would be going and starting a business or what, right? Like there's better ways to make money if you see the future than to do venture, right? So I think most of the time VCs have no idea what the future holds. So they have these theses that are really like convoluted and they don't actually, they don't really make much sense. And they're most of the time lagging indicators of what actually matters, and what's really happening in the world. And also they are like, and I wrote this in that post that, where I talked a lot about this idea of investment theses is, they by, I think one of the challenges with having a thesis as an investor is that you start looking for a company that's going to prove that your thesis is right? Because you sold this thesis to LPs, and then you sold it to yourself, right? You've convinced yourself that you've done a bunch of research, right? You convinced yourself there's something here. So now what are you going to do? You're going to see a company, and a founder comes up and they parrot back to you your thesis, and you're going to think to yourself, subconsciously or not, you're going to think, wow, this founder is so smart. And why are they so smart? It's because they're telling you what you want to hear. That's why you think they're smart. And so you're going to invest in that company, because it makes you feel smart, right? You're going to invest in that company because it makes you feel like, yes, it was all worth it. This proves everything. Now, is that the best company you've met? Or, like who knows, right? Because that's not how you're thinking about it. That's not why you're investing. And that's the problem. You should be investing in the best possible companies, no matter what they look like, where they come from, right? Who the founder is, right? Invest in the best founder and the best company, whether or not it reinforces some thesis you have about the world. So that's why I think theses for early stage investors are incredibly dangerous.
Okay. All right. Thank you. Thank you for that. Okay. So, David, what we do is we have decent big of an audience. Again, very fortunate to have everybody who listens to, watches, or read the newsletter. So we have about 20,000 founders, VCs on the newsletter side of things. So what we do
Wow.
is, yeah, before anybody is just coming on the podcast, we just send out a newsletter or send out this questionnaire like, hey, David is coming tomorrow on the podcast. Any question you would want to ask him. So we get like all kinds of questions that you can imagine, like the worst of the worst and the best of the best. So the idea is to pick the good ones to talk about and not the crappy ones, right? So I have a few that you've already answered in one way or another, so I'm not going to ask you those, but there are a few that I want to answer. I want you to answer. Okay. So the first one is, how can anyone in 2024 start a VC fund, a small VC fund?
Yeah, that's a good question. Slowly and painfully, I think is the answer. Um, Look, like I'm no expert on this. I wouldn't. I was very lucky in that I joined an existing firm. It happened to be a very early stage firm, right? So we were still emerging, right? But I didn't start it from scratch myself. But I've talked with many LPs, so I can at least have like a share a point of view on it. Um, I think ultimately LPs are looking for some sort of like there's kind of like the venture value chain, right? Like can you source good deals? Can you pick good deals? Can you and can you add value, right? Can you make those deals, those companies more valuable over time? Um, and I think you kind of need to prove that you have some differentiated edge across those things. And so that can look like I said before, there's many different ways to do venture. There's tons of flavors. So it's not about it's about figuring out like what is your edge across those and leaning into that. And one thing that every LP will want to see is a track record. So like they're not just going to believe that you're good at picking, right? You're going to need to show that you've been good at picking over time. Um, and the last thing I would say is like the kind of a well-trod path for emerging managers is to start small and grow over time. Right? So you can start with a very small fund and you're doing mainly collaborative checks, right? You're writing checks alongside, right? And I think the question you need to ask yourself is, do you want to stay in that zone or do you want to scale up and start writing lead checks? And a lot of funds make a misstep in that transition, from going from smaller, right, collaborative to larger and leading, because that's very different investing, right? Just you're not just putting more money to work, but you're also taking way more risk ultimately, and the fund math is going to start looking way different. So you need to, if you're going to stay collaborative, stay small, great, just keep doing what you're doing. If you're going to scale up, then what I've seen a lot of funds do, or a lot of investors do, is they start to make a few investments that kind of look like what that will look like one day, right? It's like if your plan is for fund two to be bigger and you start writing lead checks, then in fund one, maybe halfway through, start trying to write a few bigger checks, right? Try it out, test it, right? Like see, can you do it? Can you have some proof points so you can point LPs to that and say like, hey, we started doing it, we're able to do it, right? We're able to get the ownership we need, we're able to write the checks, right? All of that. Um, yeah, so ultimately I think it's about like these are long-term relationships, and it's about building a track record over a long period of time, and ultimately proving that you have some differentiated access, picking ability, something.
Cool. Now that you mentioned, do we need more pre-seed seed funds as well?
Do we need more? Uh, yeah, that's an interesting question. I mean, I think that my general view is that there are probably like venture is still an incredibly inefficient market, and there's probably lots of founders out there who could be great but are not able to raise money. Does that mean that we need more funds? I'm I'm not sure. Maybe, right? Potentially. Um, I think one challenge, for what it's worth, is that I think a natural reaction to what I just said would be, oh, then we need to create a fund that's focused on, an area that nobody else is paying attention to, right? So I'm going to raise a fund that invests in, you know, whatever, like ex soccer players from the Nordics who are doing whatever, right? Like some like super narrow thing. And the challenge with those sorts of strategies is, you have to believe that there are like enough really, really good companies that fit that bill. And you then also have to believe that you can see them all and that you can pick the best ones. That's just like way harder. You're increasing like venture is already really hard and you're just like making it harder for yourself by creating these constraints. Like I've always found in general, like I invest at Angular, we invest across Europe and Israel. And this is less true in the States, but in Europe, there's tons of firms that are like geographic focused, right? It's a Nordic fund or whatever. And I've always found those funds to be really challenging to wrap my head around strategically because, and it seems like it would be really hard because ultimately, what are you selling to your LPs? You're selling access to the Nordics. Right? That is ultimately what you're selling. And that means that's challenging for two reasons. One is because a big part of your pitch has to now be about like why there are great founders in the Nordics, which you have no control over, right? Like that's just like, and now you're trying to tell a story, like this nationalistic story that is just like neither here nor there, right? Like why is that, right? Like that's just a hard thing. It's hard it's hard to convince somebody of, I think. The other thing is, what if you happen to miss one of the great companies that comes out of the Nordics? You're you're done. Like what reason do you have to exist if you couldn't invest in that one company, right? Like the one company that matters from the Nordics of the past decade, you missed it, right? Like, and the problem is, I think it's pretty likely that you'll miss it because the best founders who are likely going to create the best, biggest companies, they want to go raise from Sequoia and whoever else, right? Like just as we said, like that's who they want to go raise from. So why are they why are they taking why are they taking your money, right? So I think that's why, it can be really challenging as a VC to have like a narrower and narrower slice of the market that you're trying to go after, and why that strategy is ultimately, yeah, I'm just not sure if it actually works, and like I would much rather see more YCs in the world that are super generalist, right? As well as more, like more Angulars for that matter, right? Like, yeah, we focus just on B2B, right? But we're generalists within B2B, and I think that is in my mind, that's the most interesting way to do the job and the most likely way to generate outsized returns.
What are the cap table red flags for you?
You care about a few things when looking at a cap table. One is you want the founders to own enough of the business that they continue to be incentivized, right? To do a good job, right? Like you want this to be incredibly meaningful to them. And if they don't own enough of the business, then, you know, just serves as a disincentive. The other thing is you don't want like a bunch of dead weight on the cap table. So that could be like a founder, like a co-founder that's left, right? And now like a significant portion of the business is owned by somebody who is not involved at all. Or it could be like an investor who is tapped out, right? They don't have a no fund, they can't invest any capital, so they couldn't help the company if the company needed it, right? Those are all situations where you're like, we need to fix this because we need those shares to be available for either investors who can help or employees who can help.
Are there ways to make those shares available?
Yeah, so I mean that's like what a recap is basically. Um, so you can do there are many painful ways you can do this like legally, so you can um, you can create a ton of ESOP, create a big option pool and then grant that option pool to the existing founders. So it dilutes everybody else, right? But the founders uh, gain ownership. Or you can do things like, pay to play, where like people need to invest, and if they don't invest, their shares are diluted. So this is what happens, by the way, in like normal venture time, right? This did not happen from 2015 to 2021, 2022, but I think this generally much more common now, and it's certainly something that, I mean, it happens all the time.
Yeah. Okay. Okay. Cool. Um, how much time do you spend looking at any pitch deck that you get?
Hmm. Oh man. Uh, I mean, a minute probably, something like that. I mean, will also spend way more time than that, but that's probably like well, that's like the minimum, right? Like I'll try to understand it, but
When so I'll ask you a question, which is very interesting to me as well, and interesting because again, I host people from different verticals, different with different fund sizes, different investment theses, all that. So the question is, when you get a pitch deck, what are the slides that you immediately go to? So some like one of the VCs that we host, so they're in consumer, so they invest a lot of money in consumer, so they would immediately go to GTM, like versus distribution, go to market strategy that you have, other than just saying, okay, we're just gonna run Facebook ads, So if I'm talking to a deep tech, they would just immediately go look at the team member, like, okay, if you're building an XYZ, have you worked in similar experiences before, that kind of thing. So what do you look for immediately in those pitch decks? Because you are kind of, yeah, exactly.
that's a good question. I'll tell you what, I've spent a lot of time trying to figure out the problem. So that's probably where I spend most of the time, is really trying to understand what the problem is that they've identified, and what vision they have for the future of the world, right? Like that kind of that's what I'm trying to understand really early. What I would say is the thing that I'm looking for more than anything else is something that I've never heard before. That's what I really want to see. Whenever I'm looking at a pitch deck, I want what I really want is to find something novel, you know? Because the reality is when you're sending a deck to a VC, right? Just know that they are looking at like hundreds of decks. And there's a weird thing that happens in the startup world. I don't really fully understand why, but there's this thing that happens where like people across the world will have the same idea simultaneously, right? And you see this, by the way, like this is true in startups. This is true in the history of technology too, right? People, right? Like it's been shown, right, that things are invented on opposite sides of the world at the same time, and you're like, how is that possible? Even a long time ago too, right? Like before the internet, right? It's not like people were talking about it, and it's like there's lots of reasons for this. In large part, it's because we're all building, we're all standing on the shoulders of giants here. We're all building on top existing technology and existing infrastructure. So all of a sudden something is possible. A bunch of people start working on it at the same time. Okay. So what that means is if you're working on something that other people are working on, you know, just know that the investor has probably, and this happens to me all the time, I'll all of a sudden 1 week, 1 month, see the same pitch like 7 times in a row. And when that happens, it just kind of immediately becomes way less interesting because, you kind of know that if I'm seeing 7 of these and I, as we have discussed previously, am not necessarily an investor that everybody is trying to pitch to. If I'm seeing 7 of them, I've got to assume there's 70. And why should I assume that the 7 I'm seeing are the best? Right? They probably aren't. Let's just assume they're middle of the road at best, right? But there's 70 of them, and probably there were a few that were first, and those were probably a little bit ahead of the game. Maybe they were 6 months ago they were founded. They've already raised a bunch of money from some investors in the U.S., right? So when I see like the same thing again and again, my immediate reaction is like, it's already too late. It's already uninteresting, right? So anyway, that's why what I spend a lot of time on whenever I'm looking at any deck is just like I'm asking myself, have I heard this before? Or is this actually new? And if it's really new and weird and hard, like that's when I get excited. You know, I was talking to an investor who I really, really respect a few weeks ago, and I was kind of asking him about how he spends his time, and because I feel like that's a much more interesting question than like, and whenever investors get together, there's always this like weird thing where people are like, oh, so what are you looking at lately? And you're kind of you're trying to like mine for information about what they think is interesting or what deals they're looking at without like actually asking, right? So people are like, so what do you find interesting lately? What are you finding interesting? That's what people say all the time, which is like the whole thing is like a very painful, there's like hate those conversations. Um, because it's all just like it's a show, right? We're all just kind of going through the motions, and everybody knows what is going on. It's very tiring. Um, so what I've taken to asking people is I'm like, I actually don't really care what you're looking at. I mean, like I do, but I don't care. What I really care about is like, how are you spending your time? Like dividing up your day. Like I'm curious tactically how you're doing it because I find one of the hardest things about this job is just balancing, right? Like time allocation. It's just like really, really hard. And what this guy said is he said, I find that I'm spending more and more time looking at like trying to understand markets that other people probably don't have the time or interest in understanding. And and the point that he was making was, if you think about most of the funds out there, like in this by the way, this guy's a partner at a partner only fund, so similar to Angular, right? It's just a few partners. And the point that he was making is he was like, look, like most of the funds out there, they have a bunch of associates or principals who are all filtering companies for the partners. That's basically what their role is, right? Like we're going to go source deals and filter and give the best to the partners. And he said, the effect of that is those associates want things that they can easily package up, right? That are immediately like understandable, easy to categorize, right? Like, ooh, right? Like I can package this up and give this to the partner. I know the partner likes this kind of thing, right? So I'm going to package it up and give it to them. He's like, what that means is that they're never going to look at the thing that is hard to understand. It's an easy pass, right? Like an associate talks to one of those companies, and they're going to be like, I don't even get this, right? It's not worth my time. I have to go look at 100 other companies this week, right? I need to go find something that I can package up and give to my partner. Whereas, I'm a partner. I can spend my time on whatever I want. So I'm going to go spend my time on the stuff that most people don't have the wherewithal to try to understand. And I think there's a ton of wisdom in that. And so that ultimately I'm pushing myself to try to do that as well. And so whenever I see something in a deck that like I've never heard of before, or it's just weird or it's hard, right? That's when I'm like, okay, it would be easy in this moment to just say, sorry, no, I don't get it. But actually, this is the moment when I should really try to dig in and figure it out. And look, it might lead nowhere, but every once in a while, that could be the next big thing. And the reason it's going to be the next big thing is because right now it's weird and hard to categorize, and it's new. That's why it could be the next big thing, because it's new now.
How do you think AI is going to change the VC ecosystem?
I think that the big impact that AI is having across a lot of industries is headcount replacement, to your point, right? It's like we can do more work with fewer people. The challenge with that framing with VC is that there aren't that many VCs, right? Like there aren't that many people that work in this industry. So even if all the associates and principals were replaced by whatever, right? Like it just wouldn't be it wouldn't actually have a big impact on the economy. Like it's just a rounding error of a rounding error. It just doesn't really matter. Um, Now the question is like, can AI replace investing, like investors? And maybe AI could help with like research, right? Like I can imagine that being the case, like a research and analysis platform that helps you really understand a certain market more quickly. I can see how that would be really useful for later stage investors where the markets are already pretty clear and competitive set matters, right? Like if it enables you to make informed decisions about a particular market a little bit faster as a later stage investor, I can see how that could be useful. It's a little bit harder for me to wrap my head around why that sort of product would be super useful for me as a super early stage investor, because very often we're investing in things that like
Yeah.
aren't markets yet, you
Yeah.
know?
They're not a problem of
So
today, they're problem of future, market
yeah,
of future kind of
so
thing.
like
Yeah.
that sort of platform wouldn't really be that useful. And then like look, like we already, I should say, we have a whole platform that we built obviously on top of Airtable, to like manage our deal flow and everything like that. And there's a bunch of AI sprinkled all throughout it actually that we've already built ourselves, and it helps at the margins, but it's helping us be more efficient, right? Like it's doing things like, oh, pull in a founder's profile and pull out some like a quick summary of their background so that we can understand it quickly within the Airtable, right? Like within the interface of Airtable versus like having to go to LinkedIn and scrolling through their LinkedIn, right? Like, so it's helping us be a little bit more efficient, but it's not making an investment decision for us, right? So I don't know. Probably not a very satisfying answer. I don't see the end of venture around the corner.
Awesome. Awesome. All right, David, thank you so much for the time. So we do have this one small ritual on the podcast since the episode one. So what we do is we ask all our guests a question for our next guest without telling who the next guest is going to be. Okay. So, okay. So I got a question for you, which the last guest left, and obviously going to take a question from you for the next guest. So the question from the last guest is, who is one person outside your friends and family who has inspired you the most in your career?
I worked at a company before, a few companies ago, right? I worked at a startup uh, called CompStack, which is a startup in New York City that is basically um, like crowdsources commercial real estate data and then builds like an analytics platform with all that commercial real estate data. So relatively, it's an interesting company. I was a super early employee there. I was the first, like also the first growth person there. So I did a lot of the early stage growth. But this was a sort of company that like never really reached escape velocity, right? But it's still going, right? It's been 13 years, and it's still going. And I think about this company a lot because the CEO is just like this amazing. Um, the CEO he's a commercial real estate broker by background, right? Not a startup, not a traditional startup guy, right? But he kind of pulled together a team of and found an engineer to work with him, found a designer, right? Kind of pulled this together, And there's this real sense about this business that like it wouldn't exist if not for like it was like a just a sheer force of will on his part. He had to will it into existence. And even to this day, 13 years later, it's not, this is not $1 billion business. And he is, there's something about like I think about him a lot when I meet founders, and I think about like, what does like grit really mean? What does it mean to like keep going and pushing through, right? What does it mean? What does that look like? And I often think about him, very inspired by what he's been able to build. Um, so yeah,
All right. Thank you so much, David. Thank you so much for the time, for the wisdom, for sharing all the amazing things with us. I have hosted, I think, 70 plus people so far. 80% of them are the VCs. You're the most talented / smart person that I have ever hosted. I can tell that like on record. Yeah. So thank you so much for the time.
that's very kind of you, undeserved. But thank you so much. This was a ton of fun. So thank you for having me.
This is it from today's episode. I hope you enjoyed it. Thank you so much for watching and listening. All the resources and links that we have talked about, they're all in the description or in the show notes, depending upon which platform you're on. If you're listening on Apple Podcasts, please give us a review. Would appreciate it. If you're watching it on YouTube, please mention down in the comment, did you like it? Did you not like it? What do you want us to improve? Who do you want us to invite on the channel? If you enjoyed this episode, there are chances you're going to enjoy that episode as well. So we're going to link it down somewhere here. Do hit the subscribe button if you haven't done that already. And thank you so much for watching again, and I'll talk to you soon. See you in the next one. Peace.